talking about what is the definition of a multifamily assets. There's 4 different types. We're going to go over the A, B, C, and D multifamily assets and define them. And what are the pros and cons of each asset type? I'm going to kind of go through that as we touch on each one, not as a summary at the end. And then applying your investment strategy to find out what type of assets you want to buy, and so much more. So, I love doing these webinars. I love having you join us. So hopefully you'll get some good content there. All right. So what I want to do is first go over some of these things, and then I'm going to show you how to apply them. I'm going to put them into our software that we use, CoStar, and you'll be able to see what it is or how you want to apply these. So I want to go ahead and pull up my list here. So first we want to talk about the different asset classes, and trying to get all my windows in the right place. So where's my chat here? It is gone, but I will find it back here. All right. So let's go from the top down. So like you have different asset class. And the reason we're talking about asset classes is because when you go to buy a house, let's say, you just got married and, you and your husband or wife are getting ready to purchase your first house. You don't just say, okay, want to buy a house, realtor, find us one. Okay. They want to know what kind of house, how many bedrooms, you want brick exterior? Do you want, what kind of neighborhood, close to schools and different things like that? There's no difference between that and in multifamily. Okay. You need to define the type of asset that you are going to invest in, because that helps you narrow your efforts. Same thing with picking submarkets. We've gone over that before. So if you just say, I want to buy multifamily in the US, well, you're going to be looking at a lot of deals and a lot of them are going to waste your time. So, same thing with asset classes. So you want to go ahead and narrow down the asset class that you want to invest in before you start looking at multifamily investments. So, as you get into it, and each one of these are going to be different for different groups. You have your institutional or your REITs that, maybe have less return requirements than the syndication. Or if you can buy something outright, maybe you have less return, levels that you have to hit. So everything's different for everybody. And so these are just how we break it down or how you specify. It's kind of like I said, in buying a house. It's instead of saying 1 bedroom, 2 bedroom, 3 bedroom, you're saying, an A class, B class, C class, or D class. So an A class property, that's the top of the line. There are different tiers within the A class properties, but it's kind of the, the creme de la creme, or the nicer properties. They're usually less than 10 years old and are upscale. Luxury apartments fits into the A, but it's not, your first level tier of A is just kind of new, mid-rise. It can even be garden. Mid-rise is going to be, usually 4 stories and above. Garden is going to be, your typical apartment where you have the stairs and the open breezeways. That's going to be your garden product. And then you're going to have your, but a lot of your class A's, especially your triple A, is going to be your high rise, your urban deals. Are going to have a high walk score. That means that they are close to things that people can walk to, restaurants, retail, parks, different things like that. So your downtown assets, that's going to be your urban properties. Newer assets, higher amenities, so nicer finishes typically on these Class A's. But we do like a Class A property. We like them because there is typically less work to be done. Now, I can purchase a Class A property that still has value add in it. Maybe it's less than 10 years old, but maybe they put less quality finishes than we would have put, or than the market demand. So maybe there's a competition property nearby that has marble tops and this one has laminate. We can look at, trying to get the rents up to match a little bit nicer, maybe even double A class property, by renovating this one, but it doesn't take a lot. So you get down into your older properties, your 80s properties, 70s properties, you're doing a lot more. You have maybe some wiring upgrades and, maybe some plumbing upgrades. So we do like the A class, and that's kind of what you call, so if it's cash flowing, it's A, core. So you don't have to do anything to it. A core plus, you have to do a little bit of work to it, maybe paint, maybe some light fixtures, nothing major there. Okay. So that's A class. Average rents are higher. They're going to be at the top of the market. Okay. So your high rise, your luxury, rents dependent, and this is all going to depend on what market you're looking at. Your max rents in the market in LA are going to be way different than they are in Raleigh or Houston or Houston and Austin. So all of these rent valuations are based on your submarket, but in the submarket, your A class is going to be at the top of that range. And they're generally located, like I said, in desirable areas geographically. They're going to be close to downtown or very accessible locations, good visibility, desirable, up and coming new areas, trendy areas. If you're familiar with Charlotte, you have like the NODA, which is like the artsy side of town, or you have, different submarkets. And Austin's the same way. You have the more trendy or artsy areas. So those A class properties tend to be in those new development areas, the high population growth, younger demographic typically in those areas. White collar workers typically live in these properties and rent by choice. We feel at this time in the market that is a good place to be because of some of the eviction moratoriums and different things that are in place or being talked about right now. It's just CDC really that we're dealing with, but you never know what's going to happen. And so these tend to be people of white collar. They're not necessarily being affected as much because they're probably already or possibly already working from home or able to work from home or remotely. So their job may or may not be affected, but less so than your more workforce housing, which we'll get to in a moment. So that's a good thing we feel right now is people that choose to rent, they don't have to rent. And so we feel it's a little bit stabler. Studies have shown that collections are a little bit higher on these types of assets than they are on the C class. B class is usually pretty good as well. They have the highest valuations per door and the lowest market cap rates. Now I will put a little bit of other color on the cap rate. We see very little difference in a value add deal. Let's say a 98 value add deal and a 2019, core property. It's very little. I would say 10 basis points across the markets. And that's, we started looking at a little bit nicer assets because of that. Because your B class, even upper B class and A class just did not have that much of a difference in cap rate right now. Debt has a lot to do with that, but we felt that also meant like, okay, if we're going to spend this cap rate and have to run the risk of capital expenditures and pushing rents, or we could buy this property that, we're just going to burn off loss to lease and do a better job of managing the property. That's a lot less risk to us than pushing rents on a workforce housing type property, if that makes sense. And some people say you're buying that for appreciation on the A class. I disagree. Those properties cash flow perfectly fine. Obviously, we buy properties for cash flow that we syndicate, so that you have to have cash flow to pay distributions and your debt service. So the properties are cash flowing just fine. It's all about debt structuring to get that to happen. Will it appreciate? Yes. The biggest jump between the A class and the B class is going to be your price per door. So those things get a little bit crazy sometimes. On the upper A class, it gets wild, and it depends on the submarket, but I've seen them even in Charlotte submarkets going over 300,000 per door. Just depending on Southeast, it ranges anywhere, but it's usually up over 200,000 per door in the Southeast for A class properties, and it can go up north of 300. So it all depends on what type of amenities they have there, what type of parking, if it's parking garage or podium deals, different things like that. So lots to consider on the A class. I have a couple questions. I'll deal with those on the A class before we move on. What do you see cash on cash return for A class? Our cash on cash returns do not change per the asset they have to achieve the cash on cash that we need for our investors. So if an A-class deal does not produce the cash necessary, we don't pursue it. But we do see deals, A-class deals, that do meet that criteria, and actually sometimes are a higher cash yield than some of the B-class and value-add deals. But on average, they're about the same. So that's why we started looking at that. But there are value-add deals that don't make sense on cash, and there are, because a lot of times they're wanting you to buy based on what the property can do, which is going to increase the amount you need to raise. So you're overpaying for the property for its future performance. So all those things had to be taken into consideration. Let me check my Q&A, just see what we got here. I haven't started sharing my screen. Somebody asked that. So right now I'm going to share my screen when we get into the how to apply this. And I think you'll enjoy that. Seems like all right. Yeah. So right now we're going over A class. We'll go over B class and C class. As I'm talking about A class, I'm going to reference the other classes, because they affect each other, but I'll get into the B class and C class in a little bit. Yeah. No slides. I'm old school. I don't do slides. It's a poor use of my time. So it's better for me to give you information than to give you pretty slides. So going on to the Class B properties. All right. So Class A, I'm going to recap. These are the top of the line in the market, A, AA, AAA. They're going to be less than 10 years old and upscale. Average rents are higher, generally located in a desirable geographic area. White collar workers live in them and usually rent by choice, and generally have the highest valuations per door and the lowest market cap rates, but that market cap rate is only marginal. Okay. All right. Class B properties. This is going to be kind of your right in the sweet spot of your value add, where you see most of your value add deals. Your typical garden style walk up product, surface park. Okay. So garden style, as I mentioned, is going to be the open breezeways, the stairwells that go up and the doors on the side. Surface park just means a regular parking lot. Suburban, not in downtown, basically. And we have seen a shift, more desire to go to suburban and to garden style with, because of COVID. It's not great, but it is there. And so you have to pay attention to that. So as you're purchasing properties, you have to be flexible and not static on, okay, we're buying A class and that's just what we're going to do no matter what. The market shifts, the market change. We've shifted kind of what we focus on, and we do that on a regular basis, depending on what the market is yielding and what's best for our investors. Really, that's what what can yield the highest return with the least amount of risk is what we're trying to achieve. So Class B properties, they are 10 to 25 years old. Okay. Generally well maintained, not a lot of deferred maintenance, middle class tenant base, including both white collar and blue collar workers. So pretty normal there. Most of us are familiar if you're in that space. That is kind of our sweet spot, if you will. There, it doesn't need a lot of work. Typically in a B class, we're looking at countertops, flooring, light fixtures, paint. And possibly some exterior paint. If the color schemes have kind of changed over time, it needs to be updated. Just depends on the property and the submarket and the competition. And some renters are there by choice and others by necessity. And by necessity, we mean, maybe they don't have a great credit score and they can't get approved for a home loan, or maybe they don't have enough money saved up for their down payment. So they live in an apartment because they have to. And then you still have people that live there. They like the lower rent than the A class, but they don't need to rent. Maybe they move around a lot. Maybe they're a consultant and they just, choose to rent, or they like the low maintenance lifestyle. I think about that sometimes when instead of having to mow my grass or having somebody mow my grass, I could just live in an apartment. So I don't think my wife would enjoy that as much, since we have 4 daughters and 3 dogs and 3 rabbits. So not really conducive to apartment living, but I always think of the ease of that. So again, some renters are there by choice, others by necessity. Cap rate is a little bit higher than Class A properties, but like I said, and lower than Class C. But like I said, it's not very big. I think the max you're going to see is a 30 basis difference between those. I think it's closer to a 10 or a 20 basis point difference between those two. That's my opinion. That's what I see in the market. And they're bought primarily for appreciation rather than cash flow, but they generally have more cash flow than Class A properties. But like I said, Class A cash flow just fine, and so do Class B. Class B properties tend to have a little more what we call upside. Or buying it at this NOI and pushing the NOI up. There tends to be a little more room there. Than on the Class A's, whereas a Class A, you would buy it and not do anything and just kind of, maintain the cash flow. It's already making money. So there's nothing really you need to do. You're already kind of at the market top, and you're just going at the 3% market growth annually, basically on a Class A. Class B, you tend to look at your competition and you can kind of draft off of the Class A. We have a property in Charlotte, and they're building a brand new property across the street. Which we'll see a little bit of softness because of it initially. But the good part, the reason why we like it, is after they stabilize and concessions burn off, we'll be right under them. We'll be able to draft off of them and not really have to do anything, because now they're the top leader. If we were the nice place and then they built and now they're the top leader, we're like, oh no, people will think that's a negative. This is actually not. We can raise rents and draft off of the other property and achieve more rent. So, Class Bs can benefit from a Class A in a property because they kind of set the ceiling and see where you can go. And then you try to match the amenities of the Class A. So if you've got a Class A nearby and they have granite, if you can do that within a reasonable price point and come in under those Class A's, you'll get those residents that you desire and be able to push the rents, and then work on operational efficiencies to decrease cost. All right, let me check again and see here. The Q&A doesn't look like we have anything yet. And chat. Okay. All right. No questions on B class. Anything on B class? Feel free to ask. I've got the Q&A pulled up here. So, all right, good deal. We'll move on to the next one. And I know probably most people are wanting to get into the application of this. So I'll get through the C and the D properties pretty quickly. We do not play in that space. It's just an investment strategy for us. And that's the only reason. So I'm not knocking any asset class, but it's just not where we decided to go for specific reasons. But Class C properties, they're usually built within the last 30 to 40 years. Okay. They generally have blue collar or low to moderate income tenants. Most tenants, so you're dealing when they're having to qualify to even be able to rent from you. And a lot of the applicants maybe are not able to even get approved to rent. And most tenants are renters for life, with the expectation of some tenants who are just starting out and are likely to work their way up to Class B or Class A property as they progress in their careers. So, maybe first-time renter, maybe just fresh out of high school or college, different things like that. But that's your Class C. Definitely a little more hands-on with the tenant base, rent collections, different things like that. People sometimes in the Class C less interested in the effects of not paying rent on their credit. So collections can lag on C class properties behind B class and definitely A class properties on collections. It's not great right now, but that is the lowest right now as far as collections are concerned due to COVID and the economy being affected there. So rents are below market. So remember, your A class kind of sets your ceiling and your C class is coming in under it, and your B class is in that sweet spot right in the middle. So you got a lot of range there. So again, that's why B class is a good asset class. Most attractive to cash flow investors because they offer the best cash flow, the lowest cap rates. So there's some benefits to it. It's like I said, it's a little more hands-on, a little more maintenance heavy. They're older properties, so they're going to have more things going wrong, and you may have to do more work on the value add side, maybe a deeper value add project. They can be the first to appreciate in a rising market. Some of the best deals also occur when an investor finds a Class C property in a Class B area. I know a lot of people look for that, the diamond in the rough, up and coming, and this is an older property and there's new property down the street. It's kind of that, like we talked about, that desirable area in the A class, but it's a C class. And so I can get it for really cheap, and then I can make it a little bit nicer, and look, I can draft off, people still want to live there, but you get the idea. You can kind of work off of that growth mentality of the submarket. The only thing I caution on the C class is, we've discovered this is from experience, that usually properties have a reputation within the submarket. Unless you have a lot of new outside people coming in, you're going to have a hard time overcoming that. So, you can make a property look very nice. You can renovate it, but it takes time. I'm not saying you can't do it, but it takes time to change the stigma of a property within the submarket, because people are like, oh, that place, yeah, my friend lived there 10 years ago and man, it was rough or whatever. So it takes people a while to get their minds around it. So, new signage, brighter lights, new paint on the outside, all curb appeal is very important on C-class properties. And it's very important that you do that first before you start renovating the interior, because you can have the most beautiful interiors in the world, marble and, gold trim and everything. But if it looks bad on the outside, you're not going to get anybody to want to pull in the parking lot and go inside and see those beautiful interiors. So I always recommend on the C class to start with the curb appeal and then start your interior renovations. And then of course you have, let's see, you have the D class. We never recommend this, especially if you're first getting into the space, but there are people that purchase those. Again, I'm not knocking any multifamily asset class, but they're built more than 40 years ago, typically. Many are Section 8 or government subsidized tenants, or, it's just maybe a little more run down, more deteriorated, maybe some drug activity. And again, you've heard this before, the D stands for danger, drugs, do not buy, different things like that. So, that's always kind of the bottom of the barrel there. We don't even consider them in our criteria. Okay, so that's the basic rundown of the four classes, A, B, C, and D. And so what I want to do now is go to CoStar. All right. Can everybody see the CoStar page? Just put it in the chat. Yes, you can see CoStar. Want to make sure. All right, good deal. All right, so this is Columbia, South Carolina. And you see Lake Murray there. I'll give you, I'll scroll out a little bit here, kind of so you can get a feel of where we are. Those are all commercial properties through CoStar. Okay, so I'm going to zoom in on our home location, and I want to show you kind of how how you can use this information to find the assets that you want. Because remember, you decided now, it's like you're looking at a new house and you decided, I want a 3-bedroom, 2-bath brick ranch. Okay, so A class, B class, C class, D class. Okay. All right. So if I'm using CoStar, I can do different things. So I can do a radius from a point, or I can do corridors, or I can do this number right here. And let's say I don't like the Northeast, I can kind of cut that off, and, or I want to get Irmo because that's kind of where the new growth is, and it'll filter just properties in that area. So that's kind of nice. So I'll take that off. So the first thing, do I want it for lease, for sale, for lease and sale. That's more for commercial, not for multifamily. But we go to this one right here, multifamily. Okay. And it's going to apply that filter to this map now. And you can see it changed the number of properties that are visible, but that's still a ton. We're talking about Columbia, South Carolina. For those of you familiar with Columbia, South Carolina, it's not the hot spot in the Carolinas, right? Greenville and Charleston get all the glam and glory. But look at all those multifamily properties, right? I don't want to look at all those because I'll, like I said, I'll dilute my efforts. So I'm going to go further in, and you can pick your CoStar rating. I don't usually use a CoStar rating because you can get a property that has a bad rating and you can increase it, but the structure and the bones of the property are good. So, I don't usually look at that. And sometimes, if it's a really high rated property, they want too much for it. So I'm careful with that. The listing type, existing. I don't want anything under construction or under renovation currently. This is all mostly for commercial, but you have existing here, CoStar rating, multifamily. Let's say you only want to buy over 100. Let's say we would do over 150 units and no max. And then you can go minimum rent. So let's say 1,000 to 2,000. I won't put an all beds there, but effective rent is really what, you can ask whatever you want, but your effective rent, okay, is what you're actually able to get. And then your difference between your asking rent and your effective rent is your loss to lease. So I'm not going to get that deep right there. Market sentiment rent type. So you can pick, like we talked about, affordable, you could do affordable, and then you could do rent controlled, rent restricted, different things like that. So you can filter these down. You can see that kind of got rid of all my properties because there's no affordable that are over $1,000 in rents. Makes sense. And we are slimming the pile down. Okay. And so here you see the garden, low rise, mid rise, high rise. Okay. High rise is going to be usually over 5 stories. Low rise is over 3 stories. Mid rise usually is around 5 stories. So we're going to look for garden. Unit mix. I'm not going to mess with any of that, but you certainly could. All right. So here is where you really get into the classes A, B, C, D. So let's just go B and click on that and see what we get. I am located right now. I am right in here. That's where my house is. Okay. That's where I'm coming to you from right now. So I can look at different things, properties and pull them up. Let's see where Granby Crossing, here it is. All right. And so I use this information to filter down in a submarket to find the property that I want. That was my criteria that I put in. You can see I can put in a lot more and get it even more fine tuned. So once I get to this point, I'm going to go in and I'm going to look at different things. So if this is a listed property, then I have a guidance price or a price per door that the broker has given me. Okay. And so I can actually, let me pick on sales. So if he's saying, it's going for 120 a door. Well, I can look at my prior sales comps in the area and I'm going to filter them by year built, because this is a 1990 built. And so I want to keep my comps rate in that vicinity, and I want to look at when they sold. So you can see kind of right there. And then I'll look at those amenities. Is this even a comparable property? But that'll give me a good idea of if what the broker is asking for is reasonable. Okay. And then you can go to your comps. That's going to give you your rent comp. So when I get the financials from the broker, then it will, tell me, where the rents are, and I'm going to see, is there room to push rents? So I can go to each one of these properties and look at what they're getting for their rents. Okay, different things. Now, again, I'm looking for comparable properties. I don't want to compare this guy, right, to, my garden style. If it's, so if it's brand new downtown, I'm not going to compare what they're getting for rent to, Granby Crossing, what I just saw over by the river, because I know where that one is. And then I'll go to analytics. And this is very important information. You can do all kinds of charts, but it's going to give you your vacancy rate. That's saying they have a 0% vacancy rate at the property, which is pretty substantial, but I doubt that's accurate. There must be something going on with the data there. But these are all the information that we look at, to try to qualify a deal. So you can see daily vacancy rate, and this is reflecting what is showing there on the vacancy rate. This is right across the river from USC, University of South Carolina campus. And it's the lower of the rents. You have a lot of mid-rise right there, especially on the other side of the river, closer into the campus. So this one is kind of an affordably priced place to live for students. But for us, we look at the student population as being higher than, 40%. And we say no, because for obvious reasons that fluctuates, wear and tear is a little bit higher, the partying and whatnot that goes on there. But you can see the benefits of it, okay, right now. So these, again, market rent growth, that's kind of all over the place. But we look at all these things to see population growth, rent growth, by bedroom, and then you're looking at that compared to the unit mix. So all of those things are things that we use to filter down our market. Let me go back to my main map. And LoopNet, a lot of you know of LoopNet. It is owned by CoStar. It is a free version of this. Obviously, it doesn't get quite as in depth. I can get a full underwriting report, which gives me all of the comps and everything that is going on in that neighborhood or that submarket, and have PDF reports. So I want to come back to here, look at my filters, and let's take this out. Zero. And then now let's go and let's find, they have this listed as F, but we know it as D. All right. So I want to kind of look at where these properties are going to show up. This is also going to help me kind of know or look at where maybe some of the residential areas are, or where some of the new growth is. Not necessarily, but it does. Cause like this is interesting here, because I know this area here, and then Irmo up where Wyman is up here. This is all the new growth area coming into the Columbia submarket. Now, we personally don't invest in Columbia. We live here, but if I was going to invest in Columbia, it would be here. This is kind of, a little bit rundown area. This area here, it's mixed with money and rundown. So you've got some multi-million-dollar houses, and then you've got, some pretty rough spots. But you can see kind of where they're located. Let's go down to the F granule, and they may not even have that. Yeah, it's not even showing anything in there. But that gives you a general idea of how to use asset classes to kind of narrow down your market. We use CoStar. It's invaluable to us. We could not do what we do without it. It is expensive. It's an investment, just like anything else. You know what that's like. But anybody have any questions? I want to go ahead and stop the share, and I want to go ahead and open it up for questions. Since CoStar is expensive, what other tools are available that do the same for a lower cost? There are a lot of softwares out there that are much less expensive. But I know a lot of our listeners use some of that. So what I'd love to do is because we don't, right? So we have our system, we have it in place, and but it's best if you get a feeling of what other people in the industry are using. So put in the chat right now kind of what some software that you use to do market research. There's all kinds, whether it's LoopNet or different things. Like I said, I'm not in the space. I'm not looking for new software. So I'm kind of, I'm kind of out of that loop. So go ahead and put in the chat box kind of what you're using to research the market. If you don't have access to CoStar, though, I'll give you this option. The best thing to do is ask the broker for these reports, because they have access to CoStar, or I can't remember the name of the other one that everybody uses, or your property management company. They usually have access to this because they're constantly checking comps. So ask for it from them as well, and they'll be happy to provide that to you. So that's my low cost alternative is go to the brokers or the property managers. So nobody's putting in anything that they use, really. Usually people are very happy to share what works for them. So biggerpockets.com is what somebody put. So you can put, I'm not sure if they have the market research like this, but what unit mix do you like? So 2 bedrooms are the most popular, and you want a smaller mix of 3 bedrooms. The reason is because that is a larger family typically, and they may be on their way out to a new home. So your turnover is going to be maybe higher on a 3 bedroom, but your demand for a 3 bedroom is high. So usually there's a waiting list, but you're turning those over more often than you would a 2 bedroom. Somebody that's a little more stable, they're planning to be there. Maybe they, just got married or maybe not married, and they just have a 2 bedroom for an office. So that tends to work. All right. We got some other things. Sometimes Realty Track for various reasons, and ALN, very good for some rental rates. Current using CoStar, more robust. Yeah, CoStar is the bomb.com. So we like that. All right. When you identify a target property, what process do you take to quantify the potential value add? Great question. So that comes from our comp report. We're going to pull the comp list and see, kind of where everybody falls as far as vintage, what year they're built. So around the same vintage, and see what everybody's getting. And then see what type of amenities they have. And so here's a for instance. So if I'm in a market and I'm researching comps and I find a comp property, it's near the same vintage. Okay. And they have granite and they have LVT on the flooring. And so they're nice. And my property that I'm looking at, it has laminate and it has carpet and no new light fixtures, but the rents are only different by $50. Do I want to value add that property? I mean, it doesn't have a nice amenities. Maybe I need to look at a couple others now and see if it makes sense, because if the top of the value add market for that amenity space and that vintage is only $50 greater, and I've got to spend, $6,000 to get there, I'm certainly not going to spend that capital. And that means that whoever owns that property that I'm looking at is doing a very good job of keeping up with market rents and is achieving it without having to spend the extra capital. That being said, this other property may be missing the boat, and they spent the money on the renovations, but they're bad at marketing, bad at operating, or they have bad reviews and people just don't like to live there. Maybe they're in a bad location. So you have to kind of play those factors into the equation when trying to decide that. We do leverage our property management company because they know the submarket, and we want them to kind of tell us what they think would work and what rents they could achieve based on the submarket. So they'll do a rent analysis as well. We'll compare it to our own to see if we're in line there. Again, I've mentioned this before. We don't want to set them up for, failure. We want them to kind of set the expectations and not us set like a high bar. It's like, yeah, the property works if we can achieve, $300 rent increase. And the property managers, we keep yelling at them because they can't achieve a $300 rent increase. That's a little bit, exaggerative, but I don't even know if that's a word, but I exaggerated that example just to give you an idea of why we include the managers in the discussion at the early on, before I even decide to make an offer. I want to make sure we're all on the same page. So hopefully that makes sense. All right. So looks like we don't have any more questions, and looks like we don't have any more comments. So hopefully that was helpful for everyone. If you have any further questions, you can always reach out to us at Brandon@PassiveInvesting.com. You can check out our website at PassiveInvesting.com, Rehab Wallet. Be sure to check us out, and we appreciate your support and appreciate you being here. And we hope we've helped in some way. And just feel free to reach out if you have any questions, and I hope you have a good rest of your day.